Jahangir Aziz is ready. Let's connect with him. Yeah, he's ready. Jahangir Aziz, Managing Director and Head of Emerging Market Economies with JP Morgan Research joins us. Jahangir, good morning. Thank you for joining us.
Morning.
Can I say that the Fed event last evening was more like a no event? It's time to move on. You should go to sleep and we should start a brand new day.
We shall see what the next non-farm payroll number looks like. I think, and what the next inflation print looks like. Look, I mean, the Fed was almost entirely in line with expectations. The separation principle between monetary policy directed towards inflation and other tools directed towards banking sector liquidity support, that was clarified. The fact that they did not change the dots for 2023 was essentially a balancing between the very much stronger data that has come out so far this year versus the likely credit crunch that we will be seeing going forward because of the banking sector stress. I think that the language that they use to say that instead of ongoing increases, they're going to move to some additional increases suggests that probably there's one more hike left. At least that's what we believe. That there is another 25 basis points hike in June, and that's about it for the time being. Having said that, I think ultimately it will depend upon how the US economy delivers in the next few months. And that's where the concern will be. Is the banking stress sufficient to slow down credit, to bring down the labor market and bring down growth to a sustainable point that will hint towards getting inflation down to more comfortable levels or not? The jury is out. Let's see how that rolls out. That works out.
As well, Director of Research at EPFR Global joins us on the show. Cameron, while it may have been a vote of confidence this time around and unexpected lines with what the Fed delivered, do you think that the fact that inflation continues to linger as one of the main issues is what kept the markets from, loading the move further?
The markets here having sort of prodded the Fed into recognizing that inflation was an issue, have sort of turned round and really now seem to be discounting it again, except in a good news is bad and vice versa way. So, from a fund flow perspective, what we've been seeing is actually, some rapidly developing pockets of optimism in the financial sector and technology fund groups.
Jahangir, when the Fed is indicating that they expect the US economy to head towards a soft landing, is it realistic? Yeah. Is it realistic with this inflation number and sudden contraction in growth which will happen because of US financial mess? Are we in for soft landing?
So we have I would say about 30% on a soft landing, sort of 50% for a soft landing scenario. Now, that soft landing scenario includes soft landing in the traditional term or a muddled through environment. But there is a concern, and that has been sort of something that you and I would be talking about if it wasn't for the banking sector events that happened over the last 2 weeks. That there was a strong sense that 5% wasn't enough, or something even close to 6 wasn't going to be enough, and that the economy required much stronger rate hikes to bring about sufficient slowdown into the economy. Now, the probability of that has gone down simply because the banking sector stress is now saying that the credit crunch that will happen because of the banking sector stress will do some of the heavy lifting for the Fed, and therefore the Fed does not need to go down that route. But that probability is still around 30% as far as we can assess. So I think, it isn't out of the woods. As I said that, we would really like to see whether the credit slowdown is caused because, consumers and corporates loan demand is going down. That doesn't seem to be the case so far. So let's see whether the supply side supply side problems, which is essentially that the lending standards will be tightened from here onwards, delivers that. But we have to keep in mind that all of these things, whether you're talking about monetary policy or whether you're talking about banking sector credit, all of them have significant lags with which it hits the economy. So I would say that, the probability that, you know, you don't need to tighten monetary policy may have gone down, but it's still material.
Cameron, I mean, given that you've got the rate trajectory following the economic data points at one hand, and the other, of course, is, the sort of banking crisis, if you will, which has been evaded. And you had Janet Yellen say yesterday that there was no bailout for owners or investors in any failed US banks. Just wanted to understand that, we're pretty much taking it a day as it comes when it comes to global markets. Which way do you think funds are going to move?
I think one of the things that has struck me in the past couple of weeks is that the speed with which a fairly large part of the investor base that we track concluded that the regulators in the US and Europe would not let the banking crisis develop. And I think that's sort of taken hold on a broader level. You were just discussing whether we'll have a hard landing here. It could be possible, but I think a lot of people now really believe that both the monetary and the fiscal policymakers here will do everything they can to avoid it.
Jahangir, Cameron, gentlemen, really appreciate your time and thank you for joining us.